Before the financial shock ever reached the markets, it was already rooted in politics. Long before interest rates moved or payment systems were cut, the conflict had been escalating through speeches, alliances, red lines, and power calculations. Modern geopolitics is no longer fought only with troops and tanks. It is fought with currencies, regulations, and access to systems that quietly decide who gets to participate in the global order. In this environment, economic tools are no longer neutral. They are weapons. Sanctions are not punishment after the fact. They are preemptive strikes designed to reshape behavior, weaken sovereignty, and force submission without firing a shot. When the decision was made to isolate Russia financially, it was not just an economic move, it was a political statement about who controls the rules of the global system and who does not. Welcome to Political Plot, where we cut through the noise to reveal the power plays shaping American politics. Today we are diving into how modern power is exercised through finance and politics, where sanctions and payment systems have become weapons, and how deep preparation, speed, and control of perception can allow a nation to survive and even reverse what was meant to be an economic knockout. When the financial shock finally hit, it was designed to be absolute. This was not meant to slow an economy or pressure a government. It was meant to shut a system down at its core. The global payment network that allows banks to communicate was cut, and in the language of finance, that is equivalent to severing the spinal cord. Without it, money cannot move, contracts cannot settle, trade freezes, and fear spreads faster than logic. Every historical precedent suggested the same ending: a currency collapse, banking paralysis, social panic, and a rapid economic freefall. Many experts believed it would take days, not weeks. Yet the story did not unfold as expected. While attention stayed fixed on the visible theater of geopolitics, a quieter battle was unfolding behind closed doors. The central bank leadership had long treated this scenario not as a possibility, but as an eventual certainty. For years, policies were shaped around the assumption that external systems could be turned hostile overnight. Reserves were restructured, debt was kept deliberately low, and parallel mechanisms were built quietly without fanfare. When the shock arrived, there was no improvisation. What followed was execution under extreme time pressure. The first response was swift and deliberately brutal. Interest rates were driven sharply upward, not as an economic growth tool, but as an emergency clamp. At that moment, the currency was under attack from within as much as from outside. Citizens and investors were rushing to convert local money into foreign assets, creating a self-reinforcing spiral. Raising the price of money changed the incentives instantly. Selling became expensive. Holding became temporarily rewarding. Borrowing nearly stopped. It was not elegant, but it slowed the hemorrhage. In crisis medicine, stopping the bleeding comes before healing. At the same time, financial markets were paused. To many observers, this looked like denial or weakness. In reality, it was containment. Markets in panic do not discover fair value. They amplify fear. Closing them was a way to isolate emotional contagion and prevent irreversible destruction of asset prices. It sent a signal that authorities would not allow blind panic to dictate outcomes. Time was being purchased, and in systemic crises, time is the rarest asset. Capital controls followed immediately. Without them, the remaining reserves would have evaporated within hours. By sealing the exits, money that still existed inside the system was forced to remain there. This move was unpopular in theory, but effective in practice. It protected the financial reservoir from being drained at the worst possible moment. These were not defensive gestures. They were countermeasures designed to absorb shock and reverse momentum. Stabilization alone, however, would not have been enough. A currency cut off from global trust becomes vulnerable to speculation unless its value is anchored to something real. The next phase addressed this directly. Major exporters were required to convert foreign earnings into domestic currency. Energy and raw materials, the country's strongest economic pillars, were transformed into engines that generated demand for the currency itself. Foreign currency that once sat idle abroad was forced back into circulation. The market dynamic began to shift. Then came the move that altered the entire equation. Energy exports were restructured so that payment had to be made in the domestic currency. This was not a technical detail. It was a strategic redefinition. Energy is not optional. It is the lifeblood of industrial economies. By linking access to energy directly to the currency, its nature changed overnight. It was no longer just paper supported by confidence. It became a claim on something essential. Anyone needing energy now had to participate in sustaining the currency. Speculation became far more difficult because attacking the currency meant attacking access to real resources. This decision violated traditional economic doctrine. Textbooks predicted failure. Instead, the currency was transformed into a commodity linked to physical supply. Its underlying logic changed. The rules of the game shifted in real time. Infrastructure resilience played a decisive role as well. Being cut off from the global payment system was expected to paralyze domestic banking, but a parallel internal network had already been built quietly years earlier. It was slower and less sophisticated, but it worked and it was sovereign. When the cutoff occurred, domestic transactions were rerouted almost immediately. Banks continued to communicate, settle obligations, and maintain liquidity. Internally, the system remained functional. Payment cards followed a similar path. When international providers withdrew, a domestic alternative was already in place. Daily life continued with minimal disruption. People could still pay, withdraw cash, and transact locally. For external trade, partnerships with Asian payment networks provided alternative channels. The financial system bent, but it did not break. Once the mechanical side was stabilized, the conflict moved into the psychological domain. In financial warfare, perception can be more destructive than sanctions. Rumors, fear, and uncertainty can collapse systems that are otherwise solvent. Public communication became a tool. The central bank leadership appeared calm, controlled, and precise. There were no dramatic speeches. The message was simple and consistent. Banks had liquidity. Transactions were functioning. The system was holding. That calm presence mattered. Panic slowed. Cash withdrawals eased. Hoarding subsided. At the same time, certain sensitive data was no longer disclosed. This was not concealment for its own sake. It was strategic ambiguity. Revealing exact reserve levels would have given opponents a clear timeline and targeting map. By withholding that information, uncertainty was injected into the opposing strategy. In financial conflict, ambiguity disrupts calculation. As days passed, the cumulative effects became visible. The currency stopped falling, then it stabilized, then it strengthened. Weeks later, it exceeded pre-crisis levels. What was expected to be a fatal blow became a reversal. The attack had not only failed to destroy the system, it had forced it to adapt. This outcome was not accidental. It was the product of years of preparation. Gold reserves provided assets that could not be frozen. Low debt reduced external leverage. Domestic infrastructure ensured continuity. Policies once criticized as overly conservative proved decisive under stress. The implications extended far beyond one country. A precedent was set. The most powerful financial weapon available had been shown to have limits. A new model emerged, one based on redundancy, real assets, and strategic autonomy. Other nations began studying the lesson. In modern economic history, few episodes illustrate the value of preparation so clearly. A system designed to fail instead adapted. A currency expected to collapse was redefined. And a crisis measured in days reshaped thinking for years to come. It demonstrated that in financial war, quiet planning and disciplined execution can matter more than shock and spectacle.